We are live.
Yeah, I'm call you. I'll give a missed call.
Let's give a minute and then we'll join.
Yeah.
We'll join, so we can. Namaste viewers. Good morning to everyone. Today we have Amey Sathe. Sorry Amey if I am pronouncing your name wrongly. Now the fund manager from Tata Mutual Fund. He has over 17 years of industry experience, and he is the fund manager for 3 funds in Tata's table: Tata Flexi Cap Fund, Tata Young Citizen Fund, and Tata Banking and Financial Services Fund. Amey joined, Tata's mutual fund in May 2015 as research analyst, and subsequently he has become fund manager. His previous experience includes, JM Finance, HDFC Securities, and he is a chartered financial analyst and completed his Masters of Management Studies from University of Mumbai. As a fund house, Tata Mutual Fund today manages 1,45,000 crores of assets. Out of that, about 77,000 plus crores is in equity assets, and about 68,000 crores is in debt assets. Tata Mutual Fund is one of the major players today in the mutual fund industry, and they have very high ambitions to grow. As you all know, Tata is a big group, and they are one of the largest groups in India. I would say the largest group in India, and it's backed by their credibility, for hundreds of years. And welcome, Mr. Amey Sathe, and thanks for taking time and joining us for today's session.
Thank you, Chokalingam, and thanks Prakala Wealth for having me on your platform.
Solid, and it's good that yesterday the markets have gone up significantly. As we know, everyone is in a bull market, and people all are happy. Their portfolios are looking like 20, 25, 30%. And people who entered the market in the last 2-3 years, they are saying that their old funds, for example, like when they invested like 7-8 years ago, that fund is showing 15-14% or 16% CAGR. The fund they have invested 2 years, 3 years ago is showing 25-30% CAGR. So they are saying those funds are performing badly. My old funds are performing badly. So that is the level today the market is in, exuberance. Just, I would like to know the reasons, or if you can share with our subscribers the reasons for recent, rebound in the market, and what you are, I can put it your market outlook in the sense current and in the next future.
Yeah. So it is slightly difficult for us to sort of figure out why the short-term moves happen. But what more of a big picture thing, what I can say is that I think there are 2-3 things which are going in favor of India. One is the macro. I think in macro, if you look at, I think in terms of performance, you would have seen the GDP numbers that came through on Thursday evening. I think we have one of the best GDP growth numbers that in the world one can offer. So that is clearly one big positive, that growth is sustaining, and growth is also becoming a fairly broad-based. I think obviously there are some pockets there is a stress, there are challenges, but clearly I think growth-wise, otherwise growth has been holding up well. Government stability as well as government's focus on capex is also has been quite clear, and not only that, you would have also seen a pretty sharp improvement in overall macro indicators, maybe inflation, maybe your IIP numbers, or any data, or fiscal deficit, or rupee dollar, or the interest rate movement. So clearly net on those sides, India has been doing well. We are holding up quite well, and whatever the performance that we are seeing in the market, that is after a massive selling done by FPIs, right? I think FIs have been quite aggressive sellers in Indian market. So despite that, we are holding up because our fundamentals are pretty strong. Earnings growth, even third quarter numbers that we would have seen on aggregate, we would have done around 15-16% kind of earnings growth for the index. I think those are pretty good indicators. Having said that, I think the valuations are a slightly probably I will say slightly ahead of its curve. So if you see the 5-year averages or 10-year averages, we are clearly trading at a premium to those averages. So that sort of warrants a bit of a caution purely on the basis of valuation. And valuations do matter. The dichotomy that you talked about, that 3 years back, whoever invested is making a lot of returns, is exactly the point that at that point valuations, and we are obviously referring up COVID lows, right? Technically, valuations were significantly in favor of investors at that point. So clearly the returns that they got afterwards was handsome. And so from an investor's perspective, we always think that the entry point of valuation is extremely critical. So are we in a frothy zone? I don't think so. There are some pockets where probably we are seeing some bit of frothiness. But on the other hand, you have probably two large segments of the markets that have not given any returns. You look at sector like BFSI, or you look at sector like consumer. I think last 3 years, 4 years, there is not much of a money has been made in those sectors. So clearly, I think in a market to make a money, I think you have to keep rotating, try to buy sectors or companies which are undervalued or underowned and offer a healthy earning growth. And obviously try to sort of reduce your weightage to some of the sectors or some of the companies which look overvalued, or which have or which probably are overowned also in a way. So that is the game. Probably that is the way one can sort of try to create a sustainable returns from an investor's perspective.
Okay. Now that's fine. And generally, what is your thought on market valuations? Generally there is a fear in the market. People think that small cap and mid cap have run up, and probably even Tata Mutual Fund, some time ago they restricted their flows in small cap through SIP only. And lately, last week, SEBI and Amey, they had some discussion on small cap, mid cap restriction of the flows, so that investors should not be harmed or whatever, because of which market also corrected, few days before. So what is happening over there? I mean, it's two parts. One is about the valuations that you are thinking right now, and the second is on the small cap and mid cap.
Yeah. So I think overall at a valuation level, I think we are seeing a lot of dichotomy at a sector level. So some of the sectors are trading easily 20 to 25% premium to their pre-COVID averages. And there are sectors, so sectors like IT mid cap, they are trading almost 30-40% premium to their pre-COVID levels, pre-COVID multiples. And there are, on the other hand, there are sectors like, say, BFSI, which is trading 15-20% discount to the pre-COVID levels, or in some of the cases, it can be higher also. So clearly, there is a lot of dichotomy in terms of sectors. And when it comes to market cap, I think what has happened is that, so normally when we select a stock, we normally don't look at what is the market cap of the company. We look at what is the sustainable earnings growth and what is the price that at which we are trying to buy that company. So clearly there are pockets in small cap and as well as mid cap where valuations are expensive, but there are again fairly large areas in both mid cap and small cap where valuations are attractive. So we still continue to get opportunities in those market caps where valuations are still reasonable. But having said it, obviously the kind of returns mid cap and small caps are delivered, obviously there is a lot of interest by investors to put money at this point. And what regulator is trying to do is that to have a more sustainable kind of outcome. I think in India, I think regulators have done fantastic job. May SEBI or even RBI, I think they have done a brilliant job, and their main objectives always have to have a financial stability. And this is what regulator is trying to tell everyone, that India is obviously a great opportunity, but have some bit of a caution in terms of how you are managing your liquidity, how you are managing your outflows, inflows. That is what they are trying to address. I think in India, you'll always have. So we haven't. So if you look at the market, we haven't seen a runaway bull run, right? So there are some pockets we have seen that kind of outcomes, but there are still a lot of pockets there where valuations have derated. So it is not that the valuations have gone up everywhere. We are not like a 2006-7 period where everything was going up overnight. So that is not happened. In fact, market it always happens that things get stretched on the positive side as well as on the negative side, right? And there is what has happened in saying some of the case of some PSU entities, right? I think there somehow we are seeing some bit of a froth or some bit of a sort of a too much of excitement or over ownership. Some of the private entities, we are seeing a fairly good, attractive valuation. So that is what is making market quite interesting at this point. So I will say market cap wise, not too much of to worry probably, especially when we select the stock. And that is why we always believe that I think flexi cap is always a probably a far better category from an investor's perspective, because there you get everything: large cap, mid cap, small cap in a measured way.
Okay. Good. And currently you manage 3 funds. Tata Flexi Cap, Tata Young Citizen Fund. I think it is Children's Gift Fund.
Yeah.
And then Tata Banking and Financial Services Fund. But however, during our discussion last time when we met at Bangalore, you were mentioning that banking and financial services sector as a sectoral, it is right now attractive. So probably we will focus more on banking and financial services in this discussion. So how is the general banking and financial sector looking now?
Yeah. So I think so if you look at BFSI sector, BFSI is a proxy to Indian economy, right? Because it's all domestic link. So if economy does well, I think BFSI will do well. And if as I discussed in the start, I think the macro is looking quite favorable. So we are clocking a 8% plus GDP growth. Credit growth. So in a BFSI, so if in BFSI, if I were to divide
BFSI, you mean banking and financial services?
Yeah. So there are two things. You have a lending as well as your non-lending. Non-lending, your insurance, asset management, capital marketplace, exchanges, rating agencies. All this will come in a non-lending financial. And in lending financials, you have banks, small finance banks, housing finance companies, NBFCs. So.
Okay.
So broadly, what I have seen is that everything is linked to the economy, right? In a way, lending part as well as non-lending part. And if I look at credit growth, which is more to do with the lending, and if I see the financial services as the index, almost 70-75% will be lending companies. So the lenders or the banks, NBFCs, HFCs will have almost 3/4 contribution.
Amey, just one request. Because a lot of viewers, whoever is looking or in the future also looking, they are all normal investors.
Okay.
So instead of credit, you may use the word loan growth.
Loan growth. Okay. So yeah.
I mean, kind of.
Yeah.
So people understand easily.
Yeah. We need to simplify. Yeah, absolutely. Yeah. No worries on that. So if I say loan growth for the system, we are at almost 16%. And when I say loan growth, you have to take out the HDFC Limited's merger impact, because that wasn't there in the last year's base. So 16% is a very healthy growth. And if I take you back, say 5 years or 4 years back, especially from Demon till 2021 end, we were most of the time we were in single digit, because GDP growth also was probably at 5.5%. So and as GDP growth improves, your loan growth also improves. So we are doing 8% of real GDP growth, add 4%, 4.5% of inflation, and normally system is 1.2 to 1.4x of nominal GDP growth. So broadly, 16-17% is a very healthy credit growth from a banking system perspective. So growth is quite holding up well. Second, asset quality or the bad loans problem, NPA problems. I think last decade has been a very tough in terms of asset quality, and COVID sort of was the last nail in the sort of coffin from an asset quality perspective. And now we have come a long way. So many banks or many NBFCs used to have 10%, 15% of gross NPA. Now we are at 4%, 3% of gross NPA. So we at a system level, we were used to at 12% of gross NPA. We are now somewhere around 2.5-3% of gross NPA. So clearly asset quality performance has been quite strong.
So this NPA level you are putting across the industry.
This is at the system level, India banking system level.
Banking, okay.
Yeah, absolutely. So and in the NPA system, NPA form the NPA composition, if you see, there are normally 3 or 4 components. You have a corporate NPAs, you have MSME, SME NPAs, you have agri NPAs, and you have retail NPAs, right? Agri NPAs are normally weather driven. You have a good monsoon, you tend to have a better asset quality, and vice versa. So last year has been slightly tough on agri, and you would have seen in case of say rural stress or rural or the FMCG companies numbers in rural have been quite weak. Or you are also seeing a dichotomy between the income groups, that high end incomes are doing well, but low end incomes are. So that is also all part of, probably I will say, agri rural is a stress because of the monsoon. So if monsoon turns out to be good this year, you will have a probably good outcome on agri. Second is MSME. MSME is again linked to the corporate as well as global growth. And there things are okay. Obviously, there could be some pockets where if say global growth slows down, some areas of say textiles might suffer, or so those dynamics will always be there. But on a net, till the economy is doing well, I think MSME is also holding up quite well. Corporate loans and RBI gives a lot of data points on corporate loans. Corporate loans are large corporate loans, say having a more than 1,000 crore or 500 crore of borrowing. That is how one can define as a corporate loan. I think the asset quality in corporate loans has been one of the best in what we have seen in last 10, 12 years. So corporate loans used to have almost 10-15% of gross NPA. Now we are less than 2%. And RBI also
corporate loan itself.
Corporate loan, yeah. And in fact, RBI gives a data point on 30 days due and 60 days due. That is something called little technical SMA 0, SMA 1, SMA 2. So loans which are due for 60 days. Normally, what happens is that if something is due for 60 days, normally there is a high probability it may become a NPA in subsequent quarter. So that number is less than 1% at a system level, which is one of the best asset quality trend. And so corporate is all doing well, and we haven't seen too much of a debt levels going up in corporate. So if I look at corporate credit growth, it's still in single digit. So that is one probably area of improvement that we'll have to work on next year. Because if corporate capex picks up, then this 7% of corporate loan growth has to go in double digit. And then that will make overall credit growth a lot more balanced. See, right now what is happening is that retail is still driving a bulk of credit growth. So if you see the retail, so 16% is system loan growth. But in that retail is your housing loan, personal loan, credit card, car loan, vehicle loans, all those things. Retail loans are still doing around 18, 19, 20%. Personal loan might be at a higher loan growth of say 23, 24% at a system level. But in retail also, when we look at bounce data, so what happens in retail, one good indicator is what are the check bounces. Normally we give post-dated checks, right? Or we have a ECS mandates, right? For when we take a loan from a bank or from a HFC, our account is debited on a monthly basis. So if I am giving a check to a lender and the check is bouncing, that gives me an idea whether the stress is there on the system. That check bounce data is now almost 2018 or 2017 period levels. So that check bounce data went up like this during COVID. Now it is again coming down. Okay. So retail asset quality also is holding up, and recent RBI actions that you would have seen on unsecured retail, right? They normalized, or I will say increase the risk weights. That is also a good reminder to the lenders, right? That don't go overboard on anything. I think, and the third point I will say, so asset quality is no issue. There will always be a sort of cyclical gyrations between margins. Some companies will do good on margins. Some companies will go through a margin pressure. So what has happened in last 2 years is that whichever company or whichever bank, HFC, NBFC had a floating rate loan book, they saw a margin expansion, because when rates went up, your loan book sort of immediately reprices itself. Immediately in the sense with a lag of say 3 to 6 months, but it's quite faster. But on your deposit side, the repricing is slower. So you saw pretty decent margin expansion coming through for a lot of banks, especially which have a floating rate loan book. On the other hand, some of the NBFCs or some of the banks which have a large fixed rate loan book, they went through a period of margin correction because
Okay.
that fixed rate loan book takes time to reprice.
Right, correct.
Yeah.
But how is it true that deposits from banks are being taken away by mutual funds? Is it true? Do you see that figure?
No, see what happens is that if I'm an individual investor, I'm an individual investor. Okay, I have my savings account with X bank. I put money with your mutual fund, for example. But you are going to put money somewhere. The money is still in the system, right?
Yeah.
Money is not moving out of the system. Money is still in the banking system.
But they are not getting, at 7% or 6% interest rate.
So there could be some fight for fixed deposit rates.
Yeah.
But money is not going out of the system. So I will say it's slightly misnomer or fallacy that mutual funds are eating into banks' deposits. There could be issue that mutual funds might be sort of eating into insurance sales because it's an investment product, right? So from an investor perspective, we'll always evaluate which is giving me a better return or which has a likelihood of giving me better return. So there could be that issue, but I don't think the system liquidity or the banks are facing deposit challenges because of mutual fund. So what is so on the liquidity side, I will give you 2 points. The liquidity system liquidity is impacted because of one is if people take out money from your country. So for example, when FII do large selling, right, they are taking away money. In a way, they are taking away money from the country, right? So that sort of impacts your system liquidity. Plus, there is also government spending. So you would have seen last 1.5 month, government spending actually came down and the balances with RBI was at a significantly higher level. But last week, government released, I think, almost 1.4 lakh crore to states. And that money is now started to come back. So liquidity deficit in the sense that when banks need to borrow from RBI to fund their operations, that is where we call as a liquidity deficit. When banks are with the surplus liquidity and they don't have avenues to lend, they park that money with RBI. So that is when the system is in surplus. So in December, so I'll say Jan, Feb was the probably most difficult period from a liquidity deficit perspective at this point. So we were at one point, we were at 3.5 lakh, 4 lakh crore of liquidity deficit. And if I look at yesterday's number, we are now fallen below 1 lakh crore.
Yeah, Amey, so one more question that I have. If you want to take some water, please go ahead.
Thanks.
Yeah. The one more question I have is like now earlier banking sector, when we talk about banking financial services, it's only just banks, public sector banks, private sector banks, and some NBFCs. But today, as you rightly said, the sector has grown into insurance companies, mutual fund, asset management companies, fintech companies, microfinance, lot of things have come in. So what would be the percentage at a sectoral level? So banking, NBFC on one side, and remaining insurance, stock exchanges, mutual funds, all those things. So if you divide that, will it be like 70-30 or?
I think you put it perfectly. 2/3 will be a lending and 1/3 will be non-lending. Okay, so because the profit pool, if you see, the profit pools are mostly into lending because it's still a technically it's an art that how do you give money and how do you recover that money. It's art and science. So that's why you will always have, see, over a period of it can change, right? So probably 10-20 years back, it would have been 90% lending. Now it is almost probably 65-70% lending. But yeah.
And one more thing is now, fintech companies all over the world, and India has been a leader on the financial technology, fintech companies, from UPI payment to many of those things. A lot of startups have come up, and, India is kind of a role model. India is rolling out UPI in Sri Lanka, in Europe, elsewhere, all those things. So now, there is a view that these fintech companies can eat banking system in the future. Now, so are either banks have to themselves come up like a fintech company, or they can eat? Is it a challenge to the banking industry? How do you see? Just to put some clarification.
Yeah. So I think one mistake that probably banks did was they missed the UPI bus. They ignored or they underestimated probably that, because in UPI, nobody makes any money, right? So they sort of said, since we are not making money, why should we pay attention? But what fintechs did, they did a absolutely brilliant job when they captured that UPI sort of a market, and from there they sort of tried to get into lending opportunities. But the difference between I see between banks and fintech is the compliance levels. I think the banks are significantly tightly regulated, and the compliance levels are very, very high. So if any fintech, if they can adhere to that kind of a compliance level or regulatory level, kind of levels, then we'll have to see whether the difference between their performance and bank's performance is that wide. Because and you would have seen what happened to one of the largest fintech company, right, in last 1 month, and now almost most of their accounts will be going back to banks in a way, if you read the newspaper. So clearly, if fintech, if they have to make a mark, they have to first of all have to have a very, very high levels of compliance standard, and that is why it is not that, see, financial services is a very, very regulated business. And compliance levels, you look at even AMC business or insurance business, compliance levels have to be top notch. So and what we have seen, unfortunately, is that some of these guys are always after the growth, and normally very, very high growth doesn't come at the cost of probably sacrificing some of these elements. And banks are learning very fast. In fact, to talk to top 3, top 5 banks, they are experimenting in a very, very big way. Some of the banks are trying to create a digital bank in their own banking system, and you would have seen some of the private sector banks coming up with some of those products. So banks have learned their lessons, and I don't think now they will give up on any source of business going forward. They learned their lessons from the UPI, where they actually ceded the market share, and they are not able to get back. You are still seeing Google Pays or Phone Pays of the world holding up to that market share.
Okay. So in your opinion, I mean, fintech companies in the near term cannot challenge banks. They have their own market. And
So what you will see a lot more of partnerships. See, fintechs have technology. See, technology also, I will say banks can match up. Well, if fintechs have that user interface which appeal to everyone, banks are still not able to figure it out. I always struggle why bank cannot have such kind of a sleek app. Is it that difficult? So, and fintechs have innovation. Fintechs probably have that understanding of consumer psyche, but banks have capital, banks have deposits, and banks have trust. I think it is also very, very important.
Yeah, and they have physical presence as well.
Absolutely. And physical presence cannot be underestimated. Somehow people always say that digital is the only way. I always believe. So forget India. In US also, if you look at some of the large banks like JP Morgan or Bank of America, they are also opening branches. So physical presence is extremely important. You cannot sort of get away with that. So you can have physical presence. Along with that, you have a digital presence. So phygital is a way forward in this world to have, because customer needs to see that logo.
One more question is, of late, or not of late, in the last 1 year or so, public sector banks had a dream run.
Yeah.
All the stocks and across the board, not only banking and other things also, particularly banking had a dream run. What is the outlook going forward you can discuss between private and public sector, because probably these are the 2 major constituents in the industry. So are they that much promising for PSB, public sector banks, or private sector banks? Do they have lagged? What is going on?
So last 3 years, if you see the public sector banks, start of 2020-21, the profitability was significantly depressed because they were coming after the very elongated kind of a asset quality cycle. And last 3 years, what we saw normalization in credit cost, and that sort of helped them to improve their profitability. Not only that, a lot of these bad loans sort of they were going through. Many of them saw resolutions, and most of them were 100% provided. And even if you have a haircut of say 30-40%, still 60% money comes back. So that had a very, very big impact on their profitability. And you would have seen stock prices normally follow your earnings growth. So the largest PSU bank was doing 3,000, 4,000 crore of annual profit, and now they are doing 50,000 crore of annual profit. So clearly there is a jump in profitability. So you can justify the stock price movements. I don't think there is any irrational exuberance. So there could be a pockets of tier 2, tier 3 PSU banks which are trading at 5 times, 6 times price to book. There obviously it sort of defies the fundamentals. But the frontline PSU banks, I think the stock price performance is a reflection of the kind of earnings growth that they have done in last 3-4 years. Okay. So that is what happened in the past. Going forward, our sense is that, so one of the biggest driver of this profitability improvement, apart from the margin improvement, which they showed because of repo rate increase, is the credit cost remaining very low. And credit cost has started to normalize. It is getting masked a bit because of the recoveries that they are still seeing. So large corporate recoveries are still happening, which are 100% provided. So if your 100 rupees is a loan, and if you have created 100 rupees of provision, and that loan is sort of recovered, maybe because of someone is ready to take a haircut, or there is some property underlying against it, whatever some assets or machinery, and you recover say 40 rupees of that debt, 40 rupees entirely comes to your P&L. So that kind of a benefit that they had. This happened with entire banking system, especially those corporate heavy banks. Even private sector banks also, there are few names which benefited out of those recoveries. So next year, FY25, probably we may not see this kind of a strong recoveries coming through. So, and added to that, you will also see a profitability, you also see a credit cost normalization. So which means there could be some bit of a pressure on overall ROA. And if you see right now also, ROA of PSU banks is somewhere around 1%. While private sector banks, at least the frontline private sector banks, are somewhere around 1.7 to 2%. And mid-level private sector banks somewhere around 1.2 to 1.4%. So there is a gap between profitability of PSU versus private. Just on the PSU banks side, I think there are two things that probably they can focus on. One is I think market link compensation. I think if they can get into the groove of say private guys where there are ESOPs issued or you are getting rewarded for your good performance, if they can get the culture in PSU banks, that kind of a culture, I think that will be a very good positive improvement. Secondly, I think if you see the employees per branch, I think PSU banks need to catch up with private sector banks, because right now also PSU banks are losing market share to private sector banks. If you see most of the PSU banks, their loan growth or deposit growth is still lower than the system loan growth or deposit growth, which means your market share is slowly coming down. The decline is not that fast as what we saw in last decade, but decline is still happening. So they need to catch up on that to sustain current levels. And so in our view, FY25, we are more inclined towards having a private sector lenders than having PSU lenders. This is what our thought process. Let's see how it goes through.
Okay, so the past, dream run is for PSBs, but the future is private sector, kind of.
Yeah, so I think private sector banks valuations also are now becoming far more palatable. I think far more reasonable, considering the profitability that they are showing. I think more than the debate of having a private versus PSU, I will say debate can shift to who will benefit or which companies will benefit. See, on the interest rate side, for example, I think we are somewhere close to the peak of interest rate cycle, right? We are not taking a view whether when the interest rate will come down. It might happen in July, August, December, we don't know. But clearly on a funding cost side, we are somewhere near the peak. So which means whenever rates come down over the next 2 years, you have to see which companies benefit. So in private sector banks, also there are some companies which will benefit. Some of the private sector banks will be actually at loss because they have a very large floating rate book. Some of the NBFCs might benefit. Some of the HFCs which were not able to pass on the increase in funding costs also might benefit. So I'm saying you have to probably structure the fund accordingly. In fact, this is what we have done in our Tata banking fund also in a way. that we are saying that we are now closer to the peak of interest rates, not only at a system level, but at a individual company level. So fourth quarter, you will see most of the banks as well as NBFC, HFCs seeing a funding cost peaking out. I think that should be the last quarter or some bit of a sort of flow through in Q1. But after that, logically, they shouldn't be seeing a increase in funding cost, which means whenever, and on the other hand, your loan pricing has started. So if you have fixed rated book, your disbursement still. So normally loan is on your book, disbursement is your fresh loan, technically.
Correct,
Right?
correct.
So you're already seeing a gap between your loan yield and disbursement yield.
From an investment perspective, from an investor's perspective, because most of the subscribers are, they are looking for opportunities where I can where there is possibility to make, more money. So in that respect, is it a good time to get into banking and financial services funds like Tata?
Yeah, so I think from a sector sector fund perspective, because sector fund has its own challenges, right? So from a sector funds perspective, it is important that you need to you try to enter at the bottom of the valuation, and obviously try to exit at the peak of the valuation. Obviously, some of the things are proven in hindsight only, but at a valuation side, clearly BFSI is the one pocket or one segment of the market where at least I will say 80 to 85% of stocks are trading anywhere between 10% to 25% to below their 10-year averages or pre-COVID multiples. So clearly, this is a one sector which has actually gone through a severe derating, I will say. Normally in India, we don't talk about derating. We always talk about re-rating, right? But this is the one sector which has gone through a fairly prolonged derating. So many stocks you would have seen, despite delivering a 15-16% EPS growth, has not delivered that kind of a stock price returns, right? So that makes investors' life actually a lot more better, because now you are entering a period where valuations are in your favor.
Okay.
So whenever and the performance has been holding up, I think barring few names, I think performance of BFSI has been quite decent. Only thing that BFSI faced issue is the FII selling. FII, so if you see the BFSI holding, FIIs own BFSI in a very, very big way. And they have been selling relentlessly for last almost now, I will say 18 months. And most of the, and if you see, unfortunately, domestic investors anyways were at 30-34% invested in BFSI. So whenever FII have been selling, the ability as well as willingness to absorb that selling also sort of is not there from a domestic investor perspective. So whenever FIIs actually come back, and I'm sure when they see the earnings growth, when they see a valuation comfort, they will come back, because at the end of the day, investing is all about trying to invest at undervalued companies or sectors. And then BFSI will be a biggest beneficiary. So to sum it up, I will say valuations are in investors' favor. Earnings growth is healthy. So I think it's a good time to look at BFSI from a sector fund perspective.
Correct. Okay. So what could be an expected range of return in the next 3 to 5 years? Probably, is it okay if people can wait for 3 to 5 years? Can they consider banking fund?
Yeah, 3 to 5 is a good investment horizon to consider banking fund. It is always difficult to give what is the return expectation, but I will give a more of a macro picture kind of a view. What we see is that the nominal GDP growth is around 12.5% for the country. If it holds on to it, and after that, banking sector is a 1.3, 1.2 to 1.5x of nominal GDP growth in terms of growth. So assuming all the things remaining standard, remaining stable or not changing much, I think 15-16% is something. But again, I will say it is very difficult to put any number to that. But this is
a ballpark.
Yeah, this is how one can sort of look at from a how things can pan out. I think, see, BFSI is a proxy to Indian economy. So if Indian economy remains resilient, remains strong, I think BFSI is a sector to be with. I think.
Yeah, but what we know is the sector is undervalued right now.
Absolutely.
And it can give better opportunities for investors if they invest right now. In the future, they can get 3 to 5 years time, they can get decent return.
Yeah.
Because
absolutely. So whenever we look at any sector, we always look at is it underowned, it is undervalued, or it has underperformed. So probably now all the three boxes are getting ticked in case of BFSI.
Very good, very good. And how is Tata Banking and Financial Services Fund positioned? And I mean, if you can give a little bit of details about your banking fund that you are managing.
Yeah, absolutely. So right now, as we discussed a few minutes back, that we have almost 2/3 will be lenders and 1/3 will be non-lending. In non-lending, we have a very good exposure to life insurance companies, one fintech aggregator in life insurance in insurance sector. We have one GI general insurance company. We have asset management companies as well as one distributor of assets. So there we are fairly diversified, and we have tried to capture almost all the opportunities which are available in the non-lending financial services space. On the lending space, at this point, what we are trying to do is that we are trying to sort of shift, or we are almost at the fag end of doing that. That try to have allocation to those companies which will benefit whenever there is a interest rate start to sort of decline or start to moderate, because we are definitely at the peak. We don't know the timing of rate declining, but we need to be proactive because we cannot change our portfolio positions overnight, right? In a way, we cannot be reactive. So we are trying to go overweight on those entities which have higher fixed rate loan book or which have relatively higher wholesale funding. And because normally what happens, higher fixed rate loan book will benefit whenever the rates sort of come down. And if you have a higher wholesale funding, because there the correction happens quite fast. Retail term deposit take time to reprice, but wholesale funding. So this is how we are sort of positioning ourselves, and it's a more of an active fund because we take more active calls in this. It's a sector fund. So clearly, we take a lot more active fund and try to sort of create alpha for our investors.
And your portfolio is inclined more towards private sector banks, am I right?
At this point, at this point, we are fairly largely exposed to private sector. We have probably, I will say, only one PSU name at this point.
Okay.
PSU bank name.
Okay. So now that gives your overall view about the sector. I mean, you went into detail and gave good insight about the sector, lending versus non-lending, and all those things. It has been really good, and probably Tata Banking and Financial Services Fund, if I remember rightly, at the same time you launched the 4-5 sectoral funds.
Yeah. So we had something called Own a Piece of India, where we launched all the sector funds.
Digital fund, energy fund, banking, financial services, all those things.
Yeah, consumer.
Really, and many of those funds have performed quite well. Many of those funds, all of those funds, including Tata Banking and Financial Services, they have performed quite well in the last 7-8 years since its introduction, and that has been great. And just we are, we will. I have just one more question, personal question, and then probably we may move into Q&A. Your hobbies, interest in sitting in Mumbai, what are you doing when you get free time?
Yeah. So I think good part about our profession is that we end up meeting a lot of people. So that is a very interesting part. That we meet people like you also, like on the distribution side, and we also meet our investing companies. So I think that is a true joy of probably being in the profession, that you get to meet a lot of brilliant minds and a lot of brilliant founders, entrepreneurs, or the managements. And it's really enjoyable to have conversations with all of them. In terms of hobbies and all, I think obviously I follow a lot of football. So weekends are always looking forward to, especially English Premier League and sometimes European football during midweek. And I also do a lot of reading.
I thought the Maharashtrians are more cricket-oriented people than football. You are an exception. Okay.
No, but I like football. So I've been following the sport for almost now 20-21 years now.
Wow. Okay.
Yeah, 2001 I started following when Real Madrid had all those Galacticos coming through, and Manchester United was at peak of its success. So that also probably teaches a lot of things, in a way that success is never a permanent thing. So, and we have to work hard. So clearly football is, so I like the sport because of its, I think it's passion that people have. And also it's a truly it's human. So it's a sport that sort of personifies like human minds can be the skill can be significantly stronger than your skill set. When you see a lot of small teams beating big teams just purely on the back of their willingness to run hard, willingness to put over. So I enjoyed watching that sport and following, tracking it also.
Great. Amey, probably just give me 10-15 seconds. I will get into the chat box and see if there are any questions. Yes, sir. One of the question is, Amey, is it good to invest in banking and financial services fund right now or after the election? This is a question from Karthik Kutuva.
So I think it is a good time to, you can spread out your investments over the next 3 to 6 months if you feel like election is an important trigger. I think definitely election is an important trigger. I'm not saying that. Assuming if there is any unexpected turn in the election outcome. But I think in terms of till the time economy remains resilient and valuations are in our favor, I think it is always I think the sector actually ticks all those boxes. Valuation is in your favor, earning growth is healthy, and there is a significant underperformance also from the sector. So I think if all these three things are happening, I think it's a good time to look at. You can spread out over next 3 to 6 months. That is also
equally before and after the election.
Yeah.
Kind of.
One more point probably I would like to highlight, especially for BFSI, is the role of regulator. I think RBI has done an absolutely phenomenal job. I think, and they are making sure that we have a more sustainable growth. I think so. We may not have a period of runaway growth, right? 30-40%. But we can have a 18-20% of a very sustainable growth over next 4, 5, 6, 7 years. And the kind of monitoring, the kind of I think follow-up they are doing on, especially on asset quality, I think has been quite great. So you would have seen last year also, same time we were discussing a very large corporate going through its own challenges, right? If you remember, large conglomerate. Yeah. But RBI was absolutely on top of everything. So for the first time, you would have seen regulator releasing a press release saying that bank exposure has been within limits and there is no issue. It is backed by cash flows. So clearly, regulator has done a phenomenal job of regulating things. And my sense is that if we are lucky, if this situation persists, we may not get into a bad asset quality cycle for at least next 3-4 years. I think we can have a very sustainable, healthy 18-20% kind of a loan growth for next 4-5 years. If that outcomes come through, I think it's a very good outcome from an investor's perspective also.
Okay. So the another question is, now small cap is very much high. Is it the time to withdraw the amount and put the amount to large cap mutual fund? Veduraman Tiruvengada.
I think I always believe that if you see the last 20 years averages of market, we are somewhere around 16-17% versus last 3 years average is more than 20-25%, right? So which means if long-term average is 16-17% and short-term is, the gap is this much, so at some point of time gap will come down, right? Either because of time correction or some other issues. So investors probably can reduce some of their expectations. That is how I will say. Obviously, if we get more returns, we are not going to say no to that, right? But don't have that last 3-4 years spectacular returns if you would have seen. If you're coming because of that expectation, I think temper it down, moderate it, be a little bit cautious. There is no harm being in cautious. As you said, funds which were invested in 2013-14 are giving you 14-15. So that is a more sustainable long-term returns is what investors should focus on, rather than focusing last 3 years we have made this much, so I have to make this much over. It doesn't work like that, right? End of the day, ROEs are not changing that fast. ROE of any company is not changing that fast, right? So that is a very important element that investors should focus on. That is, I always believe that you can always go for a category which doesn't have any market cap restrictions, right? So that is always better way to invest.
Right. Okay. Yeah. Sure, sure. There is a question I don't know. What about 2GO finance? I mean, individual stocks anyway we are
No,
not
we
answering.
cannot,
I don't
yeah.
know that. Okay. Anyway, then is PSB overvalued right now?
No, PSU banks are not overvalued. Actually, especially the frontline PSU banks, they don't seem to be overvalued. There could be some overvaluation in tier 3 kind of a PSU banks where government ownership is 97, 98%, float is low. There you are seeing a 5 times, 6 times price to book. The frontline PSU banks are reasonably valued. That much I can say. It is just that the question that who will have a better profitability over the next 2 to 3 years.
Okay. Sure. And this is Shruti Ramanathan. What is your view on theme-based funds as NFOs, which are in the market when compared to traditional things like CFSI funds, large cap funds, mid cap, Nifty index, etc.?
So NFO investing is like a IPO investing for us, right? So I always a bit of cautious in the sense you can always wait for 2, 3 quarters, 3, 4 quarters. What is the fund manager's philosophy? What is the fund house's philosophy? What is their investment framework? I think understand that, and then one can always see market. Anyways, our investment horizon at 15, 13, 14, 15 years or 18, 20, whatever. So if one has such a long term horizon, then waiting for 6, 9 months or 12 months, there is no harm in that.
Any views on a passive micro cap fund, please? I mean, if at all you think of not answering any questions, you may just say pass.
Yeah. No, I think I will say that active is always better, especially as you come down below the market cap levels, because in the index fund you don't have any options, right? And like in a active fund, one can go on cash, one can have a more liquid names. So those options are there for active. So I will say if you are someone is actually doing like any investing in say small cap, micro cap, my personal preference always be go with active because the risk management probably will be better in active. I think from a index fund perspective, I think large cap is somewhere one can go for index fund. But there also what I have seen is that tracking error is somehow nobody talks about in passive fund. I think somehow that is also a big element. Secondly, and last 3, 4 years, we have seen active actually doing far better in terms of beating the benchmark kind of outperform. So there always cycles. Sometimes active will do well, sometimes passive will do well. I think focus has to be on allocation to the particular investment class rather than getting into which one is should I try to save 10 basis point here or 20 basis point here. I think that beyond the point helps no one. You have to focus on your asset allocation. So you have to focus on how much equity allocation you are doing. I think that is a very important because that will determine almost 80-85% of your total returns. Of the total return that you generate, almost 3/4 comes because of that asset allocation part. So I think investor can you should take help of you as well as your team members to sort of have that kind of a articulation or understanding how to invest and where to invest and when to invest. I think these are very important elements.
Yeah. In general, in the micro cap category, it is better to be with active than with passive. That is your answer. And one more query from media. View of Tata Digital Fund and upcoming period expectations on IT industry. So, do you want to take that? I mean, Tata Digital Fund, how it will perform, or what is the outlook, and going
that is
forward.
done by my colleague. So probably what I can say, my own view on IT sector. I think and especially in the mid cap IT space, valuations are stretched. I think most of the companies are trading 25, 30, 40% premium to their pre-COVID multiples. So at that point, so the gap between multiples is very high. Expectations level are also very high.
Okay.
And whether those expectations will be met or not, that is something one has to debate. I think because this year 24 has been a complete washout. 25 there is a bit of an improvement in expectation of improvement, but is that improvement is going to be that significant which can justify their current multiples? Even large cap IT names are also trading 15-20% premium to their pre-COVID levels, and 2015 to 19 was a period also where they actually grew in somewhere in single digit EPS growth. So if they go back to that level, whether these multiples are justified or not, that is a question that investors need to ask. And also there is, I will say this is something called this AI thing. Honestly, nobody knows how it is going to impact overall outsourcing industry, right? Because it can actually disrupt. Obviously, no one is talking about much. There is only fear. We are not seeing in the numbers, but there is that disruption is real, and how it is going to shape up the some of the companies' fortunes, that we'll have to see, and multiples are actually fairly elevated. So
Okay.
that is
The IT industry.
yeah.
Good. Thank you. Then another question from Sathe. I think this is for me. At what point of time do you suggest to withdraw from mutual fund? Maybe after one cycle of 3 to 5 years, or leave it for longer than that? So my answer will be, Sathe, probably you can leave it as long as you do not need it. Withdraw only when you need it. This is not a fixed deposit product that every 3 years, every 5 years you have to withdraw and then reinvest. Don't do that. Compounding should work for you. Compounding will work better in the longer term. So as long as you don't need, just forget the fund. Let it be done. With that, Amey, thank you very much for your time here, and sharing your knowledge and insights on the banking and financial sectors with our subscribers. Probably the same thing will be in right now. It is being streamed live in YouTube. Later, it will be in our channel as a recorded video. It will be there automatically immediately after we finish this. Your viewers can take benefit out of it. And thanks on a Saturday. We always keep on a Saturday. Sorry for that, so that more people can join. So thank you for joining us on a Saturday, and on your free day. And probably next time when you are here in Chennai or elsewhere, let us meet up.
Yeah, absolutely.
Thank you.
Thanks for having me here.